are into the second part of cash flow statement. In part 1, we have discussed about the cash flow statement, the various activities, the operating activity, investing activity, financing activity, inflows and outflows. Now let us continue with some more important items in this chapter. Extraordinary items and their treatment. What is exactly the extraordinary items? Let us go through it. All those transactions of an enterprise which are distinct from its routine activities are called extraordinary items. Thus, these items are not expected to arise on regular basis. For example, insurance claim received due to loss by fire, payment of compensation paid to employees who were taken VRS. These items may pertain to operating or investing activities. Under operating activities, we are supposed to show insurance claim received against goods lost by fire or compensations paid to employees under VRS. Under investing activity, we are going to show the insurance claim received against damages of fixed assets. How are we going to show all these amounts in cash flow statement? As income received, such extraordinary items are credited to statement of P&L. So, these are deducted from net profit before tax and extraordinary items, and then shown as inflow from extraordinary item in operating or investing activity, whichever it relates to. As an expense, such amounts are debited to statement of P&L. So, these are added back to net profit before tax and extraordinary items and then show as outflow to operating or investing activity, to whichever activity it relates to. Treatment of proposed dividend as per AS4 revised. This was adopted by CBSE with effect from the session 2019-20 onwards. As per AS4 revised, proposed dividend is not shown in the balance sheet under subhead short-term provisions of current liability, as it is considered as occurrence of events after balance sheet date and is now disclosed in notes to accounts as contingent liability. Proposed dividend is payable when it is proposed by the board of directors in AGM, that is annual general meeting of the company, and is also approved by the shareholders of the company. Thus, last year proposed dividend will only be approved by the shareholders in AGM, and current year proposed dividend will be approved only in the next AGM, so it will continue to be disclosed as contingent liability. Let us see the effect of AS4 revised on cash flow statement. Proposed dividend of previous year. We know that it will be approved in AGM of current year, so it is appropriated as well as paid to the shareholders. The effects in cash flow statement. It will be added to net profit before tax of current year, and it will be shown as outflow of cash from financing activity. Proposed dividend of current year. This will be shown in notes to accounts as contingent liability. No further treatment is required in cash flow statement of the current year. Please remember, whenever proposed dividend is given to us in notes to accounts, that will be given under the head contingent liability, and from there we need to give the effect of previous year amount only. The same amount is appropriated and the same is paid as well. When you appropriate the amount, it has to be added to net profit before tax, and when you pay, it has to be shown as outflow of cash from financing activity. We have to remember that proposed dividend of previous year will become liability of the company on approval by the shareholders in the AGM. It is payable within 30 days from the AGM, that is annual general meeting. Next, operating activities. Some important points related to operating activities. If net profit made during the year is given, we know like net profit during the year is computed after charging all operating and non-operating incomes and expenses along with the provision for tax. Items pertaining to appropriation of profits like transfer to general reserve, reserve fund, DRR, proposed dividend of previous year, interim dividend, etc. are never charged to arrive at profit during the year, as these are appropriation of profits and not charge against profits. Thus, while computing net profit before tax and extraordinary items, these appropriation of profits are never adjusted if net profit made during the year is given. It's a very important point for solving short sums based on operating activities. However, extraordinary items like insurance claim against loss of goods by fire is adjusted as it is an extraordinary operating income shown to arrive at net profit during the year. If statement of profit and loss of current year is given, now when statement of profit and loss is given to us, we know that it contains the items up to provision for tax. It does not contain appropriation of profit like transfer to reserves, proposed dividend of previous year or interim dividend, etc. Thus, these items are not adjusted to arrive at the net profit before tax and extraordinary items. Only non-cash and non-current items like depreciation, amortization of intangible assets are added back, and non-cash incomes or cash from non-operating incomes like interest or dividend received, profit from sale of fixed assets or investments, etc. are deducted to arrive at net profit before tax and extraordinary items. When operating profit is given, this is also very important. It means all non-operating losses like loss on sale of fixed assets, loss on sale of investments, preliminary expenses written off are not charged to arrive at operating profit. Similarly, non-operating incomes like profit on sale of fixed assets, investments, interest and dividend received are also not shown. Also, appropriation of profits like profit transfer to general reserve, proposed dividend of previous year, interim dividend, etc. are also not shown. All these items mentioned above are not shown to arrive at operating profit. So these items need not be adjusted to arrive at cash flow from operating activities. Reserves and surplus. The difference between the opening and the closing balance of statement of P&L reveals profit or loss during the year after all adjustments for non-cash items related to non-current items like depreciation, amortization, non-cash incomes or cash incomes pertaining to non-operating incomes like interest and dividend received, profit on sale of fixed assets. So, all these items be adjusted. Provision for tax. Another very important item, provision for tax. If tax paid is given in adjustment only, it will be assumed that provision for tax and tax paid remains same. So, it will be added to profit before tax in operating activities, and it will also be shown as taxes paid in operating activity as last item. Do remember, both the effects are under operating activity only. If provision for tax is given under the head short-term provisions, then provision for tax for the last year is treated as taxes paid during the year, and it is deducted from cash from operating activity. Provision for tax for the current year is added back to net profit as it is a book entry during the current year and it will be paid only during next year. Interim dividend. It is paid during the current year over and above the proposed dividend of previous year. So, it is assumed that the amount of provision and payment is same. Now again you are talking about dividend. Dividend paid has to go to financing activity, and when you talk about keeping a provision for the same, it has to be added to net profit before tax and extraordinary items. Let us go through. It is added to net profit before tax and extraordinary item and is also shown as deduction from financing activity. Short-term borrowings. It contains items like bank overdraft, cash credit, short-term loans, etc. These are the sources of funds, and any source of fund has to be a part of financing activities. Do remember, you need not to consider these items while computing cash flow from operating activity. Current investments. Now as per the syllabus, current investments are to be taken as marketable securities unless otherwise specified. I have discussed this earlier also. So when current investments are marketable securities, so these are going to be a part of cash and cash equivalents, and while computing cash flow from operating activity, this item has to be ignored. Interest on borrowings. Now when you talk about interest on borrowings, this will include the interest on short-term borrowing and interest on long-term borrowings. Long-term borrowings includes bonds, debentures, deposits, loans, etc. If rate of interest on borrowing is given, it should be assumed that interest on the opening balance has been paid and addition or repayment of loan has taken place at the close of accounting year in the absence of specific date given in the question. It's very important. Whenever you are calculating interest on long-term borrowings, has to be calculated on opening balance only, because it is assumed that any addition or repayment has took place at the end of the year. Interest on debentures or bonds or bank overdraft or cash credit are added to net profit before tax and extraordinary items, and they are deducted from financing activities. Interest on non-current investments. This is going to be an income for us. Non-current investments includes bonds, debentures, equity shares, preference shares, deposits, mutual funds, etc. Now when you have invested the amounts in debentures, we know like we are going to get some interest there from, right? And if you have invested in shares, so you are going to get in the form of return the dividend. Interest or dividend received on investments is deducted from net profit before tax and extraordinary items, as it is income from non-operating source. And the second effect is it has to be added to cash flow from investing activities. The addition or sale of investment be assumed at the end of the accounting period in the absence of specific date. This is very much similar to what we have discussed for interest on borrowings. Whenever you calculate interest on investments, it has to be calculated on opening balance, because it is assumed that any addition or sale of investments has took place as on the last date of the year. Fixed assets. Generally we open the fixed asset account in the working notes. If we have an adjustment, let us see what all points are to be taken care of for fixed assets. First is depreciation. We know like depreciation is an expense, a loss for us, so it is to be added back to net profit before tax, as it is non-cash item in the cash flow from operating activity. And the second effect of this depreciation has to go to the ledger account that you have prepared in the working notes. Loss on sale of fixed asset is another important item related to fixed asset. So this has to be added to net profit before tax, as it is non-operating loss. and the same has to be credited again in the ledger account of fixed asset that you have prepared in the working notes. Profit on sale of fixed asset, it's an income, and being non-operating income, this has to be deducted from net profit before tax. And if it is a profit on sale of fixed asset, we will have to debit the same in the ledger account of fixed asset prepared by us. Purchase of fixed asset is a use of funds, whereas the sale of fixed asset is a source of cash under investing activity. If you find it is a purchase of fixed asset, we debit in the ledger and show as outflow of cash under investing activity. And the sale of fixed asset, it's an inflow of cash, so we add it in investing activities and we show it in credit account prepared by us. So these points are really very important when you prepare the fixed asset account in the working note. Dividend and dividend tax. Though I have discussed earlier, let us go through once again. As per the law, dividend to shareholders is tax-free, and it is a liability of the company to pay dividend tax to the government. So dividend tax will be included in provision for tax. How are we going to deal with it in cash flow statement? Let us see that. Provision for tax of current year is added to net profit. Last year provision for tax is divided into two parts. Specifically, when in the sum you are given dividend and dividend tax. Provision for tax and dividend tax. Dividend tax is a part of the financing activity along with dividend paid, and provision for tax is a part of operating activity. Dividend tax is the tax we pay on dividend. As a company, we pay it to the government. So it is going to be outflow of cash under financing activity. And we already have discussed about the provision for tax. When we make a provision, so that's to be added in operating activity in statement of P&L to arrive at net profit before tax and extraordinary items. Format of cash flow statement under indirect method as per AS3 revised. The first activity that you have to show in cash flow statement is operating activity. And the very first amount that you are supposed to show under operating activity is net profit before tax and extraordinary items. And we need to prepare a note for that. Let us see what items are we supposed to show in that note. Calculation of net profit before tax and extraordinary items. Let us see what all items are to be added and deducted for this amount. We start with net profit of current year. Please remember, we are going to show the difference over here of statement of P&L. And the difference will be closing balance minus opening balance. We start with that amount and then we can see that some amounts are added over here. The provision that you have made for proposed dividend, the provision that has been made for interim dividend, if you have transferred any amount to reserves, and also if you have made any provision for tax. So all these provisions, provision for proposed dividend, interim dividend, provision for tax, also if any amount has been transferred to reserves, these all amounts are added back to net profit. Also, like if any extraordinary item is there which was debited to statement of P&L earlier, that will be added back. Some amounts are to be deducted. The first amount you can see there, it is refund of tax credited to statement of P&L. Any amount credited to statement will have to be deducted over here. In the same way, if any extraordinary item is there which was credited earlier to statement, that also will be deducted over here. And after the addition and deduction of all these amounts to net profit, the final amount that we arrive at will be net profit before tax and extraordinary items. Cash flow from operating activity. We are again back to the same statement. The first amount I have just discussed with you, that is net profit before tax and extraordinary items, Generally, we prepare note to it. Now we need to go through some adjustments. We need to add back those amounts because of which our profit was reduced earlier. Now, why profit reduces? Which are such losses? Which are those non-cash, non-operating losses? Let us go through it one by one. Depreciation on tangible fixed assets. Then you can see there the amortization of intangible assets like goodwill, computer software, branding, trademark. These amounts are added back. Also, like if some preliminary expenses or discount on issue of debentures, loss on issue of debentures, share issue expenses, underwriting commission, these all amounts were written off earlier. So these are to be added back because it reduced the profit earlier. So we are just adding it back to know the actual flow of cash. Interest on borrowings as well. When you talk about interest on borrowings, the short term and the long term borrowings, right, including the debentures. Finally, if you have loss on sale of fixed assets or investments, this also will be added back, added in net profit before tax and extraordinary items. So basically all the losses, non-cash items, non-operating items are added back, non-operating expenses are added back. Now let us see which items are to be deducted. By way of deduction, you are supposed to show the three incomes, especially interest income, dividend income and rental income. These are to be deducted. Along with these three important items, one more important thing is profit on sale of fixed asset or investment. All these are credited in statement of P&L. So we are going to deduct all these items to arrive at the actual flow of cash. Now after the first and the second step in operating activity, first step was the net profit before tax and extraordinary items. Second was the adjustments, wherein like we have added and deducted some amounts. After these two steps, the final amount that we arrive at will be termed as operating profit before working capital changes. So it is obvious that the next part under operating activity will be changes in working capital. Let us go through. Now when you talk about changes in working capital, so you have to talk about the current assets and the current liabilities. Throughout cash flow statement, I want you to remember that if you find an increase in asset, that has to be deducted. And if you find a decrease in asset, that has to be added. And vice versa for liabilities. The same thing you can see there. The items that are added over here is decrease in current asset and increase in current liabilities. Whereas the amounts that we are supposed to deduct can be seen as increase in current asset and decrease in current liabilities. So once we are done with the changes in working capital, the final amount that we arrive at is cash generated from operations. And from the same amount, we need to deduct the income tax paid during the year. You have to remember that this amount has to be net of tax refund received. So after income tax paid, finally the amount that we get is the net cash from operating activities. If it is positive, we write it as net cash from operating activities. And if it is negative, we write it as net cash used in operating activities. Next activity under cash flow statement is investing activity. When you talk about investing activity, you talk about the fixed assets and the investments and the various incomes. Let us go through. Let us see which all amounts are added over here. Proceeds from sale of tangible fixed assets, proceeds from sale of intangible fixed assets, proceeds from sale of investments. When you talk about investments, you have to make sure that you write the investments other than marketable securities. Because we have discussed earlier also, if any marketable security is there, so that has to be a part of cash and cash equivalent. Now because of the investments, you also have some incomes, interest received, dividend received, rent income. All these are the amounts that are received, and these are the inflow of cash under investing activities. We also need to deduct some amount over here. Purchase of tangible fixed assets, purchase of intangible fixed assets, purchase of investments also, again other than marketable securities. So after addition and deduction of all these items, the final amount that we arrive at will be the net cash from investing activity if it is positive, and net cash used in investing activity if it is negative. Finally, the third activity, that is financing activities. When you talk about financing activities, you have to remember you talk about the sources of funds, either owned or borrowed. So let us see which all amounts are added over here. Proceeds from issue of shares and debentures, proceeds from other long-term borrowings, or also like increase in bank overdraft and cash credit. You have to remember that bank overdraft and cash credit is a part of current liabilities, short-term borrowings, right? So any proceeds from long-term borrowings, any proceeds from short-term borrowings will be added over here. Let us go through which all amounts are deducted. So payment of dividend of previous year or any interim dividend paid will have to be deducted here. Decrease in bank overdraft and cash credit. Now decrease in the short-term borrowings shows the payment outflow, so that's why it is deducted over here. Interest on debentures and loans, whether it is a short-term loan or a long-term, any short-term borrowing, long-term borrowing on which like interest is paid by us, again this is to be shown as outflow of cash under financing activity. And most importantly, repayment of loan, redemption of debentures or preference shares, all these are the payments, cash outflow, so they are shown by way of deduction under financing activity. After all these items, the final amount that you get is net cash from financing activity if it is positive, and if it is negative, we write it as net cash used in financing activities. After operating, investing and financing, we get the final amount as A, B and C. So all those three amounts are to be added over here. Now, if the total of these three items is positive, we write it as net increase in cash and cash equivalents. And if the total of A, B and C is negative, we write it as net decrease in cash and cash equivalents. After A, B, C, we need to add the cash and cash equivalents in the beginning of the year to get the final total as cash and cash equivalents at the end of the year. So this is how you just end up with the statement, that is cash flow statement. I'm sure like I have made myself clear with the topic cash flow statement. Please go through both the videos to understand the concept and to apply it while doing the sum. And yes, do not forget to like, share and subscribe my channel. Thank you once again. God bless you all.